All right. Hi, everyone. We are Group One, and today we're going to be presenting a bank comparison between Wells Fargo and JP Morgan. And the bank that we're really going to be paying attention to today is Wells Fargo. All right. So Diana is going to give you a brief overview of both institutions. All right, Diana, take it away.
Okay, so starting off with Wells Fargo, the company was founded in 1852 in the city of San Francisco, and they offer a broad range of financial services, including banking, investment, mortgage, and consumer finance products. They operate in over 30 countries, primarily serving in the US market, but with a significant international reach. The revenue is primarily driven by retail banking, wealth management, and investment banking services. Next up, we have Chase, which was founded in 1799, headquartered in New York City. They provide a comprehensive range of financial services, including investment banking, asset management, private banking, and commercial banking. And Chase operates in more than 100 countries, serving both individual and corporate clients worldwide. So Chase is a leading global financial services firm with significant earnings from investment banking, wealth management, and consumer banking. Now we'll be comparing the performance of Chase and Wells Fargo over the past 5 years. Specifically, we'll take a look at the cumulative returns from 2019 to 2024. So let's begin with Wells Fargo. In 2019, Wells Fargo saw a solid return of 17.52%. However, the pandemic hit hard in 2020 and the bank faced a significant drop of 43.90%, one of the worst performances for any major bank that year. Wells Fargo made a remarkable return in 2021 with a 58.98% return, the highest annual return in this 5-year period for either of these two banks. However, in 2022, Wells Fargo faced another setback with a drop of 13.94%. Fortunately, like many other financial institutions, Wells Fargo made a comeback in 2023 with a 19.21% return, and it's currently up by 13.17% in 2024. Now let's take a look at Chase. So Chase started off strong in 2019 with an impressive 40.6% return. In 2020, it faced a much smaller decline compared to Wells Fargo with a decline of 8.64%, thanks to its diverse business model and strong risk management practices. In 2021, Chase also posted strong growth with a 24.62% return. However, 2022 proved to be a challenging year for the bank with a 15.31% return. But once again, Chase showed resilience. The bank bounced back in 2023 with a 26.85% return and has continued its strong performance into 2024 with a 30.21% return year to date. In conclusion, Wells Fargo had a remarkable year in 2021, but due to its sharp decline in 2020 and the overall volatility in its performance, it has limited its long-term growth, making Chase the stronger performer over this 5-year period.
All right. So when it comes to Wells Fargo and JP Morgan Chase's 5-year stock price performance, we can see that JP Morgan Chase has experienced close to 90% growth from 2019 to 2024, whereas Wells Fargo experienced 38.98%. And the reason why mainly has to do with a variety of factors concerning Wells Fargo. For one, they have been embroiled in several different scandals, the biggest being the 2016 fake account scandal that really hurt the company when it came to its reputation, but also resulted in heavy sanctions and penalties from the actual government. When it came to penalties, there were fines, but also restrictions and other risky activities that other banks were allowed to engage in, like JP Morgan. So as a result, Wells Fargo's returns were severely affected, and this really depressed consumer confidence and investor confidence in Wells Fargo. JP Morgan Chase, on the other hand, has exemplary performance pretty much across most metrics, especially operational and customer satisfaction wise. And as a result, they really have been able to weather the storm of the pandemic and really recover their stock price between 2021 and 2024, with 2024 being their best performing year. So yeah, I'm going to be handing the presentation over to Enrique, and he will discuss the dividend, or sorry, the share repurchase information. Thank you.
Yeah, some of the common reasons why a company might conduct share repurchases are to consolidate company ownership and to increase the value of equity, because the less shares out there, the more increase in price of stock there will be, and also to signal a strong financial position to its investors. And so let's cover, can we, how do we shift to the next slide? Oh, yeah, there you go. Let's cover Wells Fargo's past 5-year share repurchases activity. As of 2019, Wells Fargo bought 24.5 billion worth of stock buyback, and this has been steadily growing through the third quarter of year 2024. However, in the year 2020, we saw a drastic drop in share repurchases. That might have to do with a series of scandals that the institution was hit by. In 2023, the firm was forced to repay approximately $10 billion in restitution because of a legal scandal. But as of the third quarter of 2024, Wells Fargo boasts 15.7 billion worth of stock repurchases, which would be a 31.9% increase from 2023. Whereas in comparison, JPMorgan Chase has conducted a series of strategic share repurchases over the past 5 years. Yeah, there you go. In the year 2019, they repurchased $24 billion worth of stock. And this was followed up by a decrease of 72.9% in the year 2020, which can be attributed to the COVID pandemic, but they have subsequently recovered to boast a $14.4 billion share repurchase activity in the year 2024 as of the third quarter. And that would mean a 48.4, almost a 50% increase since the year 2023 in share repurchases. Now I'll hand it off to my colleague who will highlight each company's dividend policy.
Okay, thank you, Enrique. So like he said, we'll be talking about dividend policy. Wells Fargo and JPMorgan Chase has maintained dividend policies that reflect their financial strategies and market conditions. JPMorgan has a reputation for stable and gradually increasing dividends. It has steadily raised its dividend payout over the years, with the most recent quarterly dividend being $1.25 per share as of 2024, showing a steady growth trend. Wells Fargo's dividend policy has been more unstable, reflecting regular and operational adjustments after financial challenges. However, in recent years, the bank has continued growing its dividends. Dividend yield shows how much income you can earn relative to the stock's price. Wells Fargo dividend yield is 2.15%, which is competitive in the banking industry, but below the industry's average of 3%. It indicates a focus on balanced capital allocation between dividends and reinvestments. JP Morgan's yield reflects a more cautious approach and their dividend payout ratio has remained conservative around 27%, ensuring flexibility in various market conditions. Wells Fargo payout ratio is higher at around 33%. However, this higher payout is sustainable but provides less room for reinvestment compared to its competitor, JPMorgan. Wells Fargo dividends declined notably in 2021, but gradually increased each year after that. In 2024, the quarterly dividend increased to 40 cents in quarter 3 and 4, showing steady growth. JPMorgan dividends remained consistent in 2021 and 2020 and 2021 at 90 cents per quarter. And then from 2022 onwards, dividends rose each year, reaching $1.25 in quarter 4 of 2024. So what does this mean? It means that for Wells Fargo, while the dividend yield is slightly higher, its historical payouts have been more unstable, indicating possible adjustments based on market conditions or earning changes. Regarding JPMorgan Chase, they offer more consistent and steadily increasing dividend payouts, which may be more attractive to income-focused investors seeking stability. Okay, so now I'll be passing it over to my partner, Kevin, for financial highlights.
All right, thank you. Hello, everybody. Today I'll be presenting the DuPont analysis comparing Wells Fargo and JPMorgan Chase. This analysis will break down the return on equity, or the ROE, into 3 components: net profit margin, asset turnover, and equity multiplier. And then using these metrics, we'll find the better recommendation. All right, so starting in the financial highlights, the ROE. Before diving in, let me quickly explain the DuPont formula for ROE, as calculated as ROE equals the net profit margin times the asset turnover times the equity multiplier. And this approach lets us a company's profitability. And the ROE. So let's look into the overall ROE for the results of Wells Fargo and JPMorgan over 2019, as you can see on the left, all the way down to 2023. And here are the numbers. And as you can see, JPMorgan has consistently outperformed Wells Fargo with higher and more stable ROE across all the 5 years. And now let's explore the next topic, which would be net profit margin. The first component is net profit margin, which measures how much profit a company earns from every dollar of revenue. So let's calculate this using the 2023 components. And as you can see, in 2023, JPMorgan has 34%, while Wells Fargo has 20%. This means that JPMorgan Chase earns 34 cents of profit for every dollar of revenue, while Wells Fargo earns only 20 cents. And this is a significant difference in profitability, while contributes to the JPMorgan's stronger ROE. So next slide, the asset turnover. So next is asset turnover, which measures how efficiently a company uses assets to generate revenue. And so example, for 2023, we calculate it as the $5.20 revenue per $100 of assets, and JPMorgan, $6 of revenue for every $100 of assets. So this shows that JPMorgan has consistently generates more revenue from its assets, reflecting its better operational efficiency. So let's move down to the next slide, equity multiplier. Finally, we have the equity multiplier, which measures financial leverage, how much in assets a company controls for every dollar of equity. For 2023, again, we'll go into the $950 in assets per $100 of equity, while JPMorgan has $847 in assets per $100 of equity. While Wells Fargo uses more leverage, this doesn't translate into higher returns. Instead, JPMorgan Chase's balanced leverage strategy is actually more sustainable. And let's move into the next slide. Thank you. ROE calculations for 2023. Let's just use that as an example again. Bring it all together. Let's calculate the 2023 ROE for both banks using the DuPont formula. So Wells Fargo, you can see as 0.20 times 0.052 times 9.5. Using all the components, we get 9.8. And JP Morgan, we're going to do the ROE as 0.34 times 0.06 times 8.47, and we get 17.25. So we can see that JP Morgan Chase's superior net profit margin and efficient asset turnover are the key drivers in its higher ROE. So in conclusion, JP Morgan Chase's consistently outperforms Wells Fargo across all the three components using the DuPont analysis. Thank you. And then we'll move on to the next part.
Hi, everyone. So I'm going to be presenting the risk management policies and supervision structures present at Wells Fargo and JP Morgan Chase. So when it comes to Wells Fargo, really, their supervision structure is predicated on, a series of scandals I mentioned previously. So the fake account scandal back in 2016, where employees were being pressured by upper management, even their managers, to create these fraudulent accounts. And these managers turned a blind eye to that entirely. On top of that, there were also two other major scandals. So in 2020, it was actually discovered that Wells Fargo was engaged in discriminatory lending practices against minority groups. And then in 2022 and 2023, it was discovered that a series of different Wells Fargo branches were actually involved in extensive money laundering. And as a result, the Office of the Comptroller of the Currency did step in and place severe penalties and sanctions on the company that really regulated what they could do. So when it comes to the supervision structures, they really responded to those issues and totally revised it. So the first line of defense consists of individual business units. And in this first line of defense, there are employees and managers who closely pay attention to the events that are going on. And this is far different from 2016, where only really the managers were responsible for assessing these risks and paying attention to suspicious activity. Today, the culture has shifted where if you see something, you say something. The second line of defense that oversees these individual business units are the independent risk management group. And what they do is basically assess the performance and then tweak the performance of these individual business units so that they're able to really reach the organizational goals and ethics goals of the company. And then the third and final line of defense is the internal audit group. This group, they run periodic random tests that assess the performance of all the business units. And then from there, they make their recommendations to the board of directors. So when it comes to risk management policies, three major changes have taken place. So ethics line has been implemented. It's a third-party ethics hotline that really prevents retaliatory action from upper management, as what had took place in 2016. Then the second major change is the creation of a compliance committee. This was ordered by the Office of the Comptroller of the Currency as something that Wells Fargo had to do in order to have those sanctions lifted. And what this consists of are independent members who really assess all the performance and make sure that the business units and the managers are keeping up with the guidelines that are put in place. And then finally, Wells Fargo has tried to improve its image with minority groups by dedicating close to $200 million back in 2023 to these marginalized communities when it came to being able to have proper loans and help when it came to buying their first house. So when it comes to JP Morgan Chase's risk management and supervision structure, so really JP Morgan Chase, they are an exemplary bank. 2021 and 2024, they received the accolade of being the best bank. So really, this is due to their supervision structure. There's 5 main committees, and from these committees are subgroups that report to these committees and make sure that operational and compliance performance is kept up to snuff. And this has really contributed to their success throughout the years in avoiding major scandals like Wells Fargo's. However, it should be noted that there have been cybersecurity issues in recent years, particularly over this past summer. There was an infinite money glitch where people fraudulently cashed in checks, pulled out money before the check bounced, and this cost the bank millions of dollars. And on top of that, there was a hack in 2024, in April of 2024, that resulted in 451,000 customer accounts being compromised. So as a result, the company has responded by really enhancing their system vulnerability and verification processes, by really getting input from public organizations that really test the infrastructure within JPMorgan Chase on a regular basis. And they also provide employee education programs regarding new scandals or regarding new schemes that are being used by hackers. On top of this, they're also heavily investing in socially responsible initiatives and projects by dedicating close to $2 trillion by 2023 to these sustainable initiatives. And this really helps lower the risk of the company investing in projects that break down due to some compliance issues. On top of this, they also have a strong ethics-based structure and culture overall. They have monthly ethics programs that teach on new subjects for all their employees that are mandatory. So overall, JPMorgan Chase kind of does have the edge here through the fact that they have been able to sustain these structures over a long period of time while kind of avoiding the major scandals that Wells Fargo fell victim to. All right, I'm going to be handing the presentation over to Enrique, and he's going to be presenting the fintech strategies for JPMorgan Chase.
So some of the fintech strategic plans that JPMorgan has come up with are actually the creation of their own department for innovative digital modernization practices. They have a whole department dedicated to innovating software and mobile banking. In fact, in 2007, Scottish Bank became the first bank to roll out mobile banking. But since then, JPMorgan Chase has been the leader in mobile banking technology. And this is due in part to their CIB department coming up with new digital innovation strategies. I think the main point for them is that they realize that more and more people are doing things on their phone and relying on their phones for their everyday lives, and so they're trying to innovate products so that they can not just maintain their client base but actually increase their client base, especially with like mobile based softwares, which leads me to my next point, which would be their software modernization, because they realize that their software of late is not up to par with the demands that a new generation of mobile banking users requires. And so they must come up with new technologies that are not just innovative, but actually catered towards the cradle to grave. And so one of the first technologies that they came up with was the AI assistant. And JPMorgan Chase can boast that they were the first ones that came up with the mobile banking AI assistant as of 2013, sorry. And they also integrate their blockchain technology into their mobile banking technology now, which makes secure transactions possible. And then they're trying to upload their data to a cloud-based platform, which would allow them to upload up to 75% of their data up to a cloud platform. which is unheard of in the industry because nobody else is doing it. And then they also have hyperspeed trading available in their mobile banking applications now, that allows day traders to invest in hyperspeed, so to speak. And in 2010, when they rolled out their mobile banking app, they had 5.6 million users. But as of the end of 2023, they boasted 53.8 million users. So the mobile banking app platform has really taken off, and there really seems to be no end. As far as their stance against Wells Fargo, they really do seem to be a formidable opponent.
All right, thank you, Enrique. So when it comes to Wells Fargo's fintech strategic planning, fintech has really been a key part of Wells Fargo's strategy. And this is shown through, the past 10 years, over 30 startups have been part of Wells Fargo's investment portfolios. And through these partnerships and investments in startups and other tech companies, they have been able to really implement AI into their systems. So the first key example is their 2023 launch of Fargo, which is a virtual assistant that they've implemented into their mobile banking app. On top of that, they also launched Vantage, which is a commercial banking platform that allows corporate customers to not only keep track of their finances, but to also receive recommendations from the AI assistant built into the app when it comes to future actions and strategies the company should pursue. Lastly, in 2023, Wells Fargo partnered with TradeSun, and essentially they're an AI document processing organization. So Wells Fargo is implementing their technologies into their loan department to really increase the volume of loans that they can process over time. And they expect this to give them a strategic advantage in that particular division moving forward. So overall, all of these, AI technologies that Wells Fargo has acquired and implemented have allowed, their platforms to grow quite by quite a big margin. A key example is their mobile banking app. For example, over from 2013 to 2023, the app has gained 1.8 million users every year, and they expect this to only increase as time goes on. So overall, Wells Fargo is well invested in fintech and wants to make this a core part of their strategy. All right, so I'm going to give the final recommendation to buy or sell Wells Fargo to Sierra. All right, Sierra, take it away.
Thank you, Cole. So the grand question, should you invest? Wells Fargo is not recommended, sadly, for investment due to weaker financial performance, governing constraints, and reputation challenges. Its Q3 2024 net income of $5.1 billion and 38.98% stock growth lags behind JPMorgan Chase's, which boasts $12.9 billion in net income and 90.75% stock growth. The Federal Reserve's $1.95 trillion asset cap restricts Wells Fargo's growth, while unresolved scandals and untested governance heighten risk and instability, meaning investors would find JPMorgan Chase a stronger and more reliable choice. And now I hand it back over to our host, Cole.
Thank you, Sierra. So that's going to do it for us today. If you guys have any questions, please email us. Thank you. All right.